Ladies and gentlemen, welcome back to another video. I'm your host, TheDividendAristocrat, and in today's video, we're going to be taking a look at which stock I'll likely be purchasing next. Now, if you are into the type of content and you do appreciate the transparency, consider subscribing to the channel. It helps me out a ton. As a reminder, this is not financial advice, and I'm just merely sharing my opinions on this channel. Now, with that being said, let's start by taking a look at my portfolio dashboard. In total, I've invested over $65,000. My portfolio value is sitting a little bit under $100,000. We did cross that barrier just a week or two ago, but since then it has dropped pretty significantly. In terms of unrealized gains, I'm at about $31,000 and my total return is at about 47% with a $3,000 dividend earned so far, and going forward I'm projected to earn $1,400 per year. Now in terms of yield, that puts me at 1.44% dividend yield on my portfolio and a yield on cost of 2.12%. Now in total, I'm at 20 different holdings in the portfolio with $3,900 in cash sitting on the side that I can deploy at any point. Now that is pretty low for my liking. It's only about 4% cash, and I would like to try to build it back up to about 10% in case we see a major decline in the stock market. Regardless, I'm going to use this cash to continue doing my weekly investments as well as any opportunities that I do find in the market. Now, without further delay, the company I do want to take a look at today is Uber. Now, if you guys have been following the channel for a while, you know I already have a pretty sizable position in the company, but there's some reasons specifically as to why I might be adding more over the next couple of weeks. Before we take a look at their investor presentation, let's first take a look and see what's happened to their stock price as of late. Hopping into Google, we can see that Uber stock is actually down 4.3% on the day. This is as of Friday's market close, and actually during the day it was hovering pretty nicely around $68, $69 per share, and I was keeping an eye on it to see if maybe it would drop a little bit more so I could purchase some more shares to add to my portfolio. Now at around 3 p.m. I'd already basically checked out for the day and started my weekend, but next thing I know, the stock price did crash pretty significantly all the way down to about $65 per share, which is pretty crazy. Now, over the past 5 days, the company is down 9%, which is what got me looking at the stock price again. I mean, we can even see that before this big drop, it was already down almost 5% over the past week. And now after the big drop, it's down 9%, which is pretty crazy. Over the past month, it's down 13.4%. Over the past 6 months, about 20%. And over the past year, it's down almost 30%, which is pretty incredible. Now we'll take a look at my individual position in a little bit, but just to give you guys some perspective, I purchased the stock in 2025 or at least the end of 2024, and at first was performing very well in my portfolio, up over 40% at some point. Since then, the company's stock price has basically gone up and down, and overall my performance was flat for a very long time, and now I'm actually slightly in the negative. Now this is a pretty big bummer. I think the company is executing very well in terms of financial metrics, but right now there's a lot of pressure on the stock price because of external factors. Now hopping into this article, we can see some of the reasons, and the main reason the stock price dipped so significantly at the end of trading day on Friday is because Waymo is exploring options to exit its partnership with Uber. Now right now, Uber and Waymo have partnerships in a few of the major cities across the US where Waymos can only be accessed through the Uber app directly. Now if they do end this relationship, that means all Waymo vehicles will only be accessible through the Waymo application, completely bypassing the Uber network. Now, I do think that if Waymo exits its partnership with Uber, this will overall be negative for Uber, at least short term, but I did definitely expect this in the long term. I think it's always been unrealistic to expect Waymo to continue operating through Uber's network exclusively, at least not in every single major city. Over time, I expected Waymo would try to shift back onto their own application, the same thing that Tesla's robotaxis are doing. Now that being said, that currently does not change my investment thesis. I think Waymo going on the Uber platform was pretty nice, but I didn't expect it to last long term. Now, if we scroll down in their investor presentation, we can see some of the important points right here that Uber does characterize, and the big thing is they're partnering with just more than just Waymo. They're partnering with hardware platforms like Lucid and Rivian, as well as self-driving technologies like Pony and Waymo. Now, of course, if the relationship with Waymo does sour and Waymo does decide to split off independently, I still think it's not a big deal because the main idea here is that Uber is investing across many different platforms for this possibility. I can't imagine that Uber is now preparing itself for a situation where both robotaxi and Waymo become direct competitors to their network, but regardless, I think with the amount of competition in the space currently, there's still a good opportunity for Uber to profit long term. Now, I do expect that some of these investments won't go so well, as some of these companies will probably go bankrupt over the next couple of years, but even if there's some other winners outside of Waymo and robotaxi, that'll definitely put pressure on the market. For smaller competitors, it likely won't be beneficial to have their own exclusive app, at least not for all their driving, and so they'll probably partner with a platform like Uber in order to try to compete with Waymo and Robotaxi. I think most people will be opposed to downloading 5 different apps in order to get a self-driving vehicle, and so they might have Waymo, Uber, and Robotaxi apps downloaded, but maybe not much more outside of that. Now, on top of that, Uber does offer some fleet management services, either directly through its own subsidiaries or through companies that they're partnering with and investing in. In terms of their financial metrics, like we all know, they've been doing pretty well overall. Their monthly trips have gone up, their total trips have gone up every single year, and even their gross booking volume has gone up pretty significantly year over year. One of their most impressive metrics that they highlight in this investor presentation is their non-GAAP earnings per share, which grew 44% year over year from Q1 of 2025 to Q1 of 2026. Now, if they can continue to grow their earnings per share at a high rate, the valuation will justify itself very easily. Speaking of valuation, we can hop onto Seeking Alpha and take a look at it for ourselves. So their non-GAAP valuation metrics are shown right here at a 24 price to earnings ratio on the trailing 12 months with a forward-looking 20 price to earnings ratio. Now, compared to their 5-year averages, this is a pretty steep discount, especially for their forward-looking price to earnings ratio. Now, the more valuable metric we can take a look at here, in my opinion, is their price to free cash flow. And that's because Uber has been focusing pretty heavily on growing their free cash flow over time. And right now it's trading at an 11 price to free cash flow on a forward-looking basis, which is very strong. If we do take a look at how quickly the company is expected to grow free cash flow per share over the next year, it's expected to grow over 23%. Now, if that does hold true over the next year and continues to grow in double-digit rates over the next couple of years, Uber is trading at a very good price right now. Now, taking a look at some of the remaining financial metrics, we can visualize it pretty well right here. This is their 10-year graph showing their price growth over time. But what's more important here is these financial metrics. The revenue per share is growing extremely fast over the past couple of years. The earnings per share used to be negative, but it's since flipped positive and now is growing, which is great to see. And the same can be said for their free cash flow per share. This is probably the most impressive graph for the company. You can see that after IPO for a very long time, the company was free cash flow negative and many investors did not think it could turn it positive anytime soon. But in 2022, we saw the first year of profitability and they were able to continue that momentum going forward, quickly growing it into 2023, 24, and 25. And that's why I initially started investing in the company. Now, I think going forward, this growth is of course going to slow down, but I think it's going to continue being strong in terms of free cash flow generation. They're going to continue growing it for many years to come. For shares outstanding, they were issuing more shares for a pretty long time, but now from 2024 to 2025, it stayed pretty flat and even gone down just a little bit, which is something I'm pretty excited to see. Now, I think a big reason for that can be seen in this graph right here. So this is free cash flow versus stock-based compensation. It used to make a huge portion of free cash flow being much larger in 2021, 2022, and making a significant portion of 2023's free cash flow. Now, since then, the company has continued to grow free cash flow while slowly reducing the amount of stock-based compensation they do give out. So it makes a much smaller portion of free cash flow nowadays. Now, I do hope that this trend will continue, making the company much more profitable and much more resilient long term. Now, in terms of net income margin, of course, when net income was negative, the margin was negative as well, but since then, it's flipped positive, which is expected. For capital expenditures, the company is very software light because it mostly offers a software service. Now, I believe that they do also have a hand in some fleet management as well as some AV technology development, but outside of that, there's not much going on. Now, I think that the ideal scenario for Uber is one there's many small competitors in the robotaxi space, all of which want to compete amongst each other and therefore come onto the Uber app in order to get the most amount of distribution and network effects. Because of that, I think it's advantageous for Uber to continue investing in Waymo and robotaxi competitors. That way there's more than just one winner in the space. Now, before we do end this video, let's take a look at my personal holding in Uber. It's actually a pretty large position, now down a little bit over 1%, which is a pretty big bummer. Now, I don't mind buying certain companies and their performance lagging short term. Same thing with Intuit right here. But the reason it's a bummer with Uber is because it's continued to deliver very well on every single earnings call since I purchased it. And at first it was getting rewarded for it. Like I mentioned earlier in the video, at some point the company was up over 40% in my portfolio. But since then, as you can see, it's dropped to the negatives. I think this is pretty unjustified. I understand there's a lot of fears surrounding the whole robotaxi competition, but at the same time, I do think there's going to be more than one winner in the space and that Uber is going to profit from it overall. Looking at my overall position, we can see that my cost basis is at $66.62 with a current price of $65.94. Now, although I am in the negatives, I think I got a pretty good entry price on this position. I wish I would have been purchasing it right now instead of last year because I could have used the money for something else in the meantime. But of course, you can't predict these kinds of downturns. Now, it's a pretty large position of mine. We'll take a look at my exact allocation in just a moment, but it's at $5,700 invested with $5,670 of current value. In terms of allocation, that puts me at 5.9%, which is one of the biggest positions in my portfolio. Now, with this recent decline in stock price, I'm definitely considering adding more into my position over the next week if the stock price remains either flat or goes down below 65 a share. Now, if it does, I think I'll slowly start dollar cost averaging just a little bit more into the position, but I have to be a little bit careful at these levels. Although I think that these risks are a little bit overblown, they are still real risks for the company, and I want to be careful not to allocate too much money into the position. Regardless, I don't plan on cutting any of my position in the meantime, and will continue looking for opportunities to add to it if the stock price does go down. As always, that does bring us to the end of today's video. I really hope you guys enjoyed taking a look at my portfolio and seeing why I'm deciding to purchase more shares of Uber if the stock price continues to go down. Now, if you did make it all the way to the end of the video, let me know whether or not you're buying Uber in the comments below. I'd love to hear it. If you haven't yet watched my last video where I talk about how much dividend income my 300 shares of schd pay me, check out this video right here. And if you want to see my dividend income for the month of June, check out this video right here. Remember, the best time to invest was 10 years ago. The second best time is today. I want to thank every single one of you guys for watching, and I will see you in the next one.